Hi everyone, welcome to this edition. I'm Charlie Carnaccio along with Ken Mann, and we have been talking about accounting and personal accounting and business accounting. A lot of this area we had said before is made up of small businesses, but what is a small business? And Ken, can you describe what the difference is between a small business? What actually makes up a small business?
Well, that's going to probably vary from person to person. So I'll define our term that we use for small business and the clients that we serve. So for us, a small business it could be a sole proprietor, mom and pop, but basically up to about 20 employees and anywhere from $50,000 a year in annual sales up to about $3 million in annual sales. After that, from my perspective, it's no longer a small business. Other people may classify them different, but that's the term that we use for small business at Freedom Financial Solutions.
Okay, and then we also were talking about terms and different terms that people need to know as you get into accounting. That could be a little confusing at times, or just the status of how you're looking at something. Is it cash or is it accrual? And what's the difference there?
Well, that's a big issue that business owners also struggle with. So cash accounting is the numbers hit your books when you receive income or when you make a purchase. Whereas accrual, it hits your books the moment you enter an invoice or you enter a bill. So as a business owner, you're actually going to be looking at your books in both ways, especially if you are invoicing clients and you are taking in bills from customers, from vendors. And the reason for the two or to look at both is cash. You want to know exactly how you're doing at the moment in time with the money coming in, coming out. Accrual accounting is going to also help you track who still owes you money, how long they've owed you money, and who you still owe money to. And so it's important as a business owner to look at both of those, because from the cash point of view, because that's most tax returns are going to be done from the cash point of view, you want to know exactly what your income and expenses are. But in terms of tracking your income, you need to look at that from the accrual point of view, because you want to know who still owes you money, when's it coming in, and get a better idea. You can do projections then, because if you invoice someone on December 31st and that money comes in January 1st, it's not going to affect your tax return that year. It will affect your tax return the following year, and so looking at it from both perspectives is going to help you. Also, from a sales tax point of view in New York State, the sales tax is always reported on the accrual basis. So you may invoice somebody in a sales tax period but not receive payment to the following sales tax period, but you're paying the sales tax on the period that you invoiced them.
That's a dangerous proposition in some ways, because you're paying for money you haven't gotten yet,
exactly.
And who knows if you get the money in some cases.
Exactly, and then you have to deal with amended returns and a bunch of other stuff. So it is important for a business owner to understand both the cash side and the accrual side, and QuickBooks helps you do that very well. You can just change your reports from cash to accrual immediately in the filter in the customization section.
So as a business owner, I'm trying to get a sense of what the barometer is of where my business stands at this moment in time. You're saying that there are two ways to look at it. You're looking at it through two different glasses.
Right.
And there's the here and now and there's the projected. But how do I know, snapshot, how I'm doing?
Well, the snapshot cash is going to tell you what's going to affect you on your income tax return, right? But how you're doing as a business, the accrual is going to tell you that bigger picture. So you may only have a very small profit from the cash point of view because you have a bunch of invoices that haven't received payment yet, and all of a sudden everybody pays you in December, and you go from a very small profit to a very large profit at the end of the year. And if you're not prepared for that, you're going to be hit with some tax consequences that you might not be expecting. So that's why it's important to always be checking both of those when you're reviewing your financial statements.
Okay, and then the other thing that we were talking about in a previous episode was assets and liabilities.
Yeah, so assets and liabilities are accounting terms. I like to make them a little more personable. So assets are what the business owns, and liabilities are what the business owes. And then when you look at both assets and liabilities, they're always going to be broken down from current to long term. So current are things that can be converted to cash very quickly. So obviously the first thing is going to be your bank accounts. Your accounts receivables are going to be up there because you expect to get paid, usually within 30 or 60 days. It's important to pay attention to your receivables too, because if they go to 90 days and longer, they become considered uncollectible, and then you got to find Guido and a baseball bat and send people out there to chase down those receivables. You don't want to do that. So you're going to go from short term then to longer term assets. You might own vehicles vehicles, furniture and equipment, things of that nature. So the balance sheet's going to go from your short-term assets to your long-term assets, things that you own. The opposite side of the liabilities are things that you owe. So your short-term liability is going to be like your credit card debt, your sales tax liability, your payroll tax liability, and then the long-term is going to be your notes, like if you have a mortgage on a building or you have a car loan or a truck loan or equipment loans, those are going to be long-term. And again, that's going to go short-term to long-term. The last thing in the liability section is the equity section, which is the business owner's contributions in and money taken out. And ultimately, it's equity is considered a liability because the business owes that to the business owner. Right. So the thing that makes the balance sheet work is whatever the net income is from the profit and loss gets filled in under the equity section on the balance sheet. So the balance sheet can't exist without the profit and loss. Those two statements have to work together.
And so how does depreciation fit into all of this?
So depreciation works against the assets that are going to be the things that you own on your books. And so typically at the end of the year, you get what's called an adjusting entry from your tax professional that takes whatever the depreciation is on the asset, and that's a whole nother section just on depreciation, but we will lower the value of the asset on the books, and for that 1 year's value of depreciation, that also gets entered as an expense on the profit and loss. And so the value of the assets on the books are going to be lowered each year until they're fully depreciated, and then they have a zero value on the books, but they're still there until you actually sell them. So that way we can determine how much value that asset has when the sale takes place to determine whether you have income or loss from that sale of that asset.
So what is in a snapshot, what's the benefit of depreciation?
Depreciation allows you to use money today for tax benefits tomorrow. So you can choose to what's called Section 179, which is write off all of your assets right away, or you can choose to take what's currently allowed, the special 50% bonus depreciation, so you can take more of it, or you can spread that depreciation out over the life of the asset. Could be 5 years, could be 7 years, could be 15 years, depends on the particular asset. And depreciation allows you as a business owner a chance to make choices as to whether you want to accelerate that subtraction earlier in your business life, or if you want to save it down the road. Because especially for new businesses, the thought is, you have a lot of money that goes out up front and not a lot of income, and as the future goes out, you expect to make more and more income, so you get to use that investment that you made today to lower your taxes down the road. But that's a decision that should be made every year at tax time with your tax professional or your accountant, whoever you're working with, to get that done.
Yeah. Well, Ken, thanks once again. Lots of great information. And if you would like any more information about Ken and Gina and their business, Freedom Financial Solutions, you can check out the website right here at the bottom of your screen.